Our classroom stock portfolios of dividend-paying companies had a fantastic week, and our main portfolio, a dividend-growth stock portfolio, has an annual return of 22.42%. And our high-yield stock portfolio is performing even better with an annualized total return of 30.66%, which is pretty crazy, especially considering that it contains zero tech stocks. So what is this slide showing? It's showing the portfolio value over time for our main portfolio, which invests almost exclusively in dividend growth stocks. In 2022, we started investing $12.50 each week into the portfolio, and it's now worth $2,203.30 after 132 weeks. Each week, we take that deposit and split it up to buy 10 different dividend-paying stocks, so that's about $1.25 per stock. Hi, Professor Rex here. If you're new to my channel, I teach college accounting, and I often show my students how to use accounting concepts that I teach to pick stocks because it grabs the attention of my students and gets them engaged. To show them accounting concepts in action, starting 2.5 years ago, each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 a month, into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings and investing goals and get ideas of company names that they can do their own research on. There are timestamp links in the description of the video in case you want to just jump to the list of stocks we bought this week or the list of our best performers or any other section of the video. Now in 2022, the year we started the portfolio, the market did not perform well, but because I don't believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then in 2023, stocks took off. Currently, the portfolio's value is over $2,203. The portfolio's return has been 20.42% per year. Last year, the portfolio's return was 28.6%, which beat the S&P 500, and in the preceding year, the portfolio once again beat the market. Because June just ended, and since June is the end of the quarter, I created this slide to show how the dividends are growing in our dividend growth portfolio. The graph shows the cumulative dividends we've received so far. Our dividends this quarter increased 51% over last quarter, and our dividends this month increased 87% over last month's dividends. In this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those nearing retirement. The table at the bottom of this slide shows a portfolio comparison when both portfolios existed. The high yield portfolio was started in August of 2023, and the annualized return so far is 30.66%, which is surprisingly higher than our dividend growth portfolio, which has an annualized return of 24.71% over the same time period. I would expect that the dividend growth portfolio would have the higher return over the long run, especially since the high yield portfolio has zero tech stocks. But time will tell. Now remember, the high yield portfolio has only existed for 11.5 months, so its annualized return will likely jump up or down to a greater extent than our dividend growth portfolio, as we definitely saw this week with this huge jump in total return. So let's talk about why we invest in dividend stocks. The first reason we stick with dividend-paying stocks is, according to a Hartford study over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average return has been much lower at 4.27%. The study is updated each year and was recently updated to include last year, so go check out the source link that I included at the bottom of this screen. Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion. Dividend-paying stocks have a higher return and less volatility than non-dividend-paying stocks. And the historical return of all stocks has been about 10%. Maybe more importantly, historically, dividend-paying stocks have less volatility than non-dividend-paying stocks. It's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, which is a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolio only invests in dividend-paying stocks that have increased their dividend recently. Now, the holy grail of dividend investing is having a stock portfolio that produces, one, a growing stream of income that produces enough income to cover your expenses plus extra cash to cover travel, vacations, luxury purchases, etc. And two, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. Here are two examples of stocks growing their dividend payouts over the years. The first stock is Broadcom. Don't forget that Broadcom is splitting its stock 10 for 1 tomorrow, so I've adjusted the dividend amounts accordingly one day ahead of time. Now, I bought Broadcom, a chip maker, in 2020, just 4 years ago, for my taxable account. At the time, its yield was 5.01%, meaning that for every $100 I had invested in the stock, I would receive $5.01 every year. The company has quickly grown the dividend to the point where the yield based on the original investment is now 8.13%. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well into the future. And if not, that's why we have constructed a diversified portfolio. This is the power of investing in a quality dividend growth company. My second example of a high-quality company with a history of raising its dividend is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at that time. And Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I had invested in the stock, I would receive only 83 cents. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield based on the original investment is now 31.1% per year. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now aren't going to get that high of a yield because the stock's price has risen. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly won't find a bond that pays anywhere close to yields on cost that these two stocks are paying. And bonds don't increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $123,250 of tax-free income each year if you are married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses but grows over time. And if you're married and filing jointly, you can make up to $123,250 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. This is perfect for retirees. And if you're single, that amount is $61,625. Oops, I skipped too far ahead in my presentation. It says, and those amounts, as shown on the screen, often increase each year as the standard deduction increases and the tax brackets are adjusted. So how are those amounts calculated? First, you find the 0% tax bracket for long-term capital gain. This is provided by the IRS. And then add that to the standard deduction, which is found in IRS Publication 505. As you can see in 2024, the standard deduction increased, meaning that you can potentially earn even more tax-free income from qualified dividends. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $123,250 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why do we choose to invest $12.50 per week, which is essentially the same as $25 per paycheck? The next slide explains that. The main reason why we invest only $12.50 per week into the portfolio is because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my current brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck into the Dividend-Growth stock portfolio, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. The research we discuss in class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of $11.74. For a classroom stock portfolio in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. And in year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. Now, a very popular exchange-traded fund, also called an ETF, that only holds dividend stocks is the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. Now, SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our classroom stock portfolio. As of today, our classroom stock portfolio's value is over $2,203. If we had instead invested the same exact amounts into SCHD on the same days, the portfolio's value would only be $1,920, a difference of 14.8%. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our classroom stock portfolio stocks. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. SCHD has at times had large positions in stocks that I consider to be value traps. This slide shows our best performing stocks in our Dividend-Growth stock portfolio based on when they were initially purchased. Despite the rotation out of tech stocks on Thursday by investors, Broadcom is still at the top with a total return of 205.8% in a little over 2 years, which means it has tripled. Broadcom is a chip maker, and as we mentioned, will split its stock 10-for-1 tomorrow. And Evercore, an investment bank, moved up to the 3rd position. And making its debut on the list is Eli Lilly, a drug company that has seen its stock soar on the performance of its weight loss drugs. It has a 65.6% total return in less than 7 months. And after I made this screenshot for this slide, I noticed that ASML is in yellow, which is supposed to mean we sold the stock, but that's an error. We have not sold that stock. And remember that total return includes both the dividends the company has paid, as well as an increase in the stock price. Now let's turn our attention to the strategy column, specifically the category called Dividend-Growth stocks. 90% or more of our investments made in this portfolio were made in these Dividend-Growth stocks, which means they are high-quality stocks with a great track record of increasing their dividend payouts to investors. The other 10% or so of investments so far have been invested in usually smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are usually smaller companies, but studies have shown that they historically beat the market averages by a significant amount. Now, this slide shows our best performing stocks this week. Now, we had so many stocks that performed well this week that I had to break it down into 2 slides. This first slide shows our best performing dividend growers and high yield stocks. And on the next slide, This shows our best performing under the radar dividend payers. All of these are very small companies, and most had their best day on Thursday when investors rotated out of large tech companies and moved into smaller companies. Before we look at the 10 stocks we bought this week, here are the 10 dividend growth stocks we bought a year ago, along with their total returns, which of course includes dividends. Goldman Sachs is the best performer of the stocks that we bought that week so far, providing a total return of 54.6%. We still own all the stocks except the stocks in yellow, and most of these stocks are purchased over multiple weeks, which is why many have appeared in recent videos, but this slide only refers to the investment made a year ago. The average return of the 10 stocks we bought a year ago is 27.04%. And here is the usual financial disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activities. It's all well and fine to get investment ideas from others, but you always need to do your own due diligence. Now, we don't sell stocks often, and this week was no exception as we made no sales. Now let's talk about the dividend growth stocks we bought this week. Here are my ratings for the top 13 dividend paying stocks this past week. We purchased the 10 stocks that are not in the yellow highlight. The stocks in yellow have already grown to be 4% or more of the portfolio, so we did not invest more in them this week because we want to build a more diversified, less risky portfolio. Remember, each week we buy 10 stocks, and since we're investing such a small amount each week, it means we are buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we are buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it amongst the 10 stocks that we are purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we are purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature, but we think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. This table on this slide includes the company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The most undervalued stocks this week appear to be Comcast, Nike, and Papa John's. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates that they're likely to continue to raise dividends. Therefore, this is a dividend growth strategy. The stocks with the highest yields are, in order, Interpublic, Papa John's, Chevron, and Comcast. On this slide, I want to show the companies or the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% or more of our purchases. The other 10% or so far have been invested in smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies have shown they historically beat the market averages by a significant amount. All the stocks we bought this week qualify as high quality and are dividend growth stocks, which means they have a history of substantially raising the dividends that they pay to their shareholders. Risk is the first quality component shown on this slide, which we mentioned in the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of the reported earnings. And remember, earnings just means profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest looking at Nike and American Express. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings this week are Thermo Fisher, Visa, and MasterCard. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Comcast, Nike, Interpublic, and Chevron. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade, dividend growth potential, the companies in the best position to increase their dividends substantially are Thermo Fisher, MasterCard, and American Express. The companies with the best combination of recent dividend increases and potential of future dividend increases are Comcast, Thermo Fisher, Visa, MasterCard, and American Express. On this slide, we're looking at stocks in our portfolio that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. This week, Enterprise Products, which now has a 7.2% yield, increased their dividend for the second time in less than a year for an annual increase of 5% in total. On Friday, my favorite bank stock, JP Morgan, announced quarterly results that beat analyst expectations, and CEO Jamie Dimon stated in the conference call, "Last month we announced that the board intends to increase our common dividend for the second time this year, resulting in a 19% cumulative increase compared with the fourth quarter of 2023. Now, for our dividend growth portfolio, we sold JP Morgan a while back in order to buy an under-the-radar dividend pair, but JP Morgan is still a member of our portfolio that only invests in dividend growth stocks, while avoiding the under-the-radar dividend pairs. JP Morgan has provided a total return of 54%, which is 34% per year since it's been held for multiple years. The last 17 dividend increases for the portfolio have an average of 16.6%. This slide shows stocks in our portfolios that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, and there's a lot of them, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and the dividends per share that we received once a stock split has occurred. And as you can see, Broadcom will be trading with its new price on Monday. Here's a look at the 10 stocks that make up the largest portion of our dividend growth portfolio. Microsoft is still on top. Allegion made the biggest move from 7th to 2nd place. I'm not sure if I've seen a stock make that big of a move yet. Remember, our portfolio is to build our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock. But I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. Now, it's true that our portfolio's return would likely be higher if we always invested in our top 10 stocks, regardless of the size of the stock's portfolio allocation. But that also creates a more concentrated and more volatile portfolio, and many investors cannot psychologically stick with a volatile portfolio. Volatility, which means going up and down a lot, often causes investors to panic and sell at the worst time possible. Our portfolio holdings are 94 and have remained steady lately, as the last time we purchased a new stock was back in May. That might seem, now 94 might seem like a large number of companies to keep track of, but the spreadsheet we have developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information into the spreadsheet for over 3,000 stocks, which we do at least weekly, and doesn't take that much time. It doesn't take that much time since we have the process somewhat automated. Now, I have had several older students who are closer to retirement take my accounting classes. They are more interested in stocks with higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts. So we're almost to a year doing this, about 11 and a half months. The portfolio as a whole has an annualized total return of 30.66%. Since the portfolio has been in existence for less than a year, that return will likely fluctuate a lot. Currently, the portfolio's dividend yield is 4.38%, but the companies in it likely won't grow their dividends as much as the stocks in our dividend growth stock portfolio. Therefore, this portfolio would be more geared towards investors closer to retirement. Having said that, many stocks in the portfolios have increased their dividends, pushing the portfolio's yield based on the amount that we invested to 4.99%. Two strategies are being implemented in this portfolio, as you'll see on the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth and so far is the better performer. The average investment in this strategy has provided a total return of 14.18% and has been held for an average of 154 days so far, which is an annualized return of 36.9% using Excel's rate function. Now, it's not likely that the portfolio can keep up an annualized return that high since stocks historically averaged 9 to 10% each year. On the next slide, we'll look at the high yield dividend paying stocks we bought this week. Oops, but first, this is a new slide I added. This week I added this slide about the sector breakout of our high yield dividend paying stock portfolio. The odd thing that strikes me is the performance has been extremely good despite absolutely no exposure to technology stocks. One potential strategy that a person could use would be to combine this strategy with an allocation of tech stocks. So now we can look at this high yield dividend paying stocks we bought this week. Now, one thing that's different about this higher yield strategy versus our dividend growth strategy on the previous slide is we only buy 8 stocks per week, and we have 2 different strategies within this portfolio. Strategy 1 emphasizes a high dividend yield over dividend growth. This is perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yield but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in strategy 1 and 4 stocks in strategy 2, giving us 2 rankings. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Now, having 2 strategies within one portfolio also means that a stock could appear in both strategy 1 and strategy 2. If that's the case, instead of the stock getting a 1/8 weighting, they get 2/8, which is 1/4, equivalent to 25% of that week's investment. Both strategies still only invest in high quality stocks, meaning a quality rating of B- or better. The 4 high-yield dividend stocks we bought this week while implementing Strategy 1 are Interpublic, Devon Energy, Chevron, and Gilead. And the 4 high-yield stocks we bought this week while implementing Strategy 2 are Interpublic, Papa John's, Chevron, and WEC Energy. This week's purchases have an average yield of 4.6% with, let's see, the highest one is Devon Energy at 5.9%. Here's a look at our ratings for competitive advantages, management, and financial health. And on this slide, we can see their grade for recent dividend growth and current yield, as well as recent dividend growth history. And in the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consist of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. So in the comments, let me know if you have any questions and also what other kind of investing videos you'd like to see. And finally, here are the places you can reach me: YouTube, obviously, as well as X and LinkedIn, and my website, beatthestockmarket.com. I'll see you again next week with a list of stocks we will have bought on Monday.